Hi, everybody. Greetings. Welcome to today's Cathedra webinar. We're coming to you live on April 22nd, 2025, and you are tuning in for day 2 of the 5-day series on NAHASDA Intermediate. Your instructor is Cheryl Cosley, who's principal of Cheryl A. Cosley and Associates. My name is Brooke Warrington. I'm the Training and Development Specialist at the Native Learning Center. We're also grateful that you could tune in for today's webinar. If you could quickly follow along while I read the disclaimer aloud. This webinar provides a summary of fundamental concepts, requirements, and/or procedures within the allotted 90 minutes, and the material discussed does not illustrate all possible scenarios that could be applicable. We also have our copyright infringement law printed here, so just a friendly reminder that the webinar materials are protected by copyright, trademark, trade secret, and other intellectual property laws. Moving forward in the learning platform, if you need to access the recordings of the webinars, or if you are going back and you want to share the slides with a colleague or anything, all of that can be found in the courses section. I encourage you to look at the other webinars we've hosted as well. All the recordings and slides and information are housed for those as well. And when you are ready to join, now that you've registered once for the learning platform, you're on it for good. You'll just log in whenever there's a webinar happening and you'll click on that green banner at the top of the screen. We ask that you join with listen-only capability. It just helps to cut down on audio feedback for our instructor. And if you joined and you found that the audio is coming out of the wrong device, maybe you're trying to listen on your headphones or you have a speaker plugged in, then you can click on that little telephone icon at the bottom of the screen, and that'll bring up a list of your microphone and speaker devices, and you can select the right one. There's a lot of ways to interact during today's webinar. We'll primarily use the public chat. We do, of course, want to encourage comments and questions. If you have any tech support issues you need help with, you can let me know in the public chat. But you'll just expand it by clicking on that public chat section. Type whatever message you want to send, and then you can hit enter or click on the little paper airplane button to submit. There is already a link to today's slides in the chat, and I will put it down a little bit lower for easier access. There are other helpful links in the section that says shared notes. You can find a link to all of our webinar recordings on YouTube. There's a link for today's presentation feedback survey. A lot more stuff in there. We'll ask you to go ahead and take a second to introduce yourselves before we get started. You can let us know your name, where you're tuning in from, your work or your role in Indian country that led you to today's webinar, and then your tribal affiliation if you have one. Some of you might be tribal employees and you don't, that's okay too. Just a quick note before I hand it over to Cheryl. If you guys click on that red menu panel that's to the far left of the screen, just know that it is going to pull you out of the webinar and take you to whatever you clicked on. You can just rejoin by quickly clicking on that green banner once again, and you'll come right back in. I just want to give you a little heads up. All right, folks, while you are getting that chat box going, it's with great pleasure that I introduce your webinar instructor, Cheryl Cosley. And Cheryl, I have made you presenter now.
Thank you so very much. Trying to make reservations up there all morning to get up there. Delta doesn't fly in until mid-June, so I'm gotta even move weeks. It's been interesting. So welcome to NAHASDA Intermediate Day 2. And thank you for joining us again. This is brought to you courtesy of the Native Learning Center and HUD, the Department of Native Housing. Welcome and good afternoon, and in your case, good morning for our participant from Alaska. My information is at the beginning and the end. Should you ever need anything in the future, please reach out. My name is Cheryl Cosley. My Anishinaabe name is Redbird Woman. I'm Loon Clan, and I come from Place of the Pike in my language, Kenoshtinconning, which is the Bay Mills Indian Reservation, and we're located in the Upper Peninsula of Michigan. We still have snow, lots and lots of snow yet. So one of these days it'll actually be spring. I served as director of housing for my tribe for over 28 years. And during that time, I served as chairperson for our local housing association, the 31 tribes surrounding the Great Lakes. And I served on the National American Indian Housing Council. I did that for a total of 16 years. Started out as, secretary, went to vice chair, and then I was a 2-term chairperson. So I've been really, really lucky that I've been able to work throughout Indian country and help our people my entire working career. I started Cheryl A. Cosley and Associates in March of 2019, providing training and technical assistance through the lower 48 and Alaska. So I'm very, very lucky to be able to continue to work with all of our people. So this is to help make sure that you expend your monies correctly when you accept those grant funds from the Indian Housing Block Grant, and to hopefully make sure that you don't make any mistakes when it comes into some of the areas that we have to make sure that we have policies and procedures and things like that. So today we're going to look at management capacity, development capacity, some of those eligibility requirements for our tenants. Can't serve them if you don't put them in the IHP and if they're not eligible to begin with. And we'll talk about adjusted income, those statutory deductions. There's a lot of slippage in Indian country sometimes about those deductions. I've seen them say, well, you can have this one, but if you do, you can't have that one. Well, that's not what statutory deduction means. It means you give it to them whether you want to or not. And you can add more if you, take the right steps, and that's what your governing body decides is a good idea to do. We'll talk about other program assistance, for your low income people and some of those eligible activities. So that's what we're going to do today. And then we'll hit the rest of it throughout the rest of the week. So reference materials, please grab them while you can. Put them on a thumb drive, stick them in your drawer, but at least you'll have them. Right now, there's been problems with our website, and I don't ever want to see somebody not be able to grab information and reach out and utilize that just because it's not readily available. So if you would, look that over and grab some of your stuff. So questions, if you could jot them down if you have any about this segment, I'll try to answer them at the end. And I'll try to get you out on time. I'm horrible about that because I always know they need this information also. So we're going to talk about compliance criteria, your audits, and, development capacity. Can you manage that project? So are your ducks in a row? Sometimes I felt like I was doing really, really good if my ducks were in a circle. They weren't necessarily in a row, but I had the ducks, so that's sometimes how you feel. So really old guidance, I reached out. I have a student in here that reaches out every once in a while and says, Cheryl, what do I do here? Or do I need this? And he's in here right now. And he asked me about policies. So I reached out to 2 different HUD offices, and the policy guidance goes all the way back to like 2002 or 1999. And it's the only guidance that's there. When I go back into guidance like that and I read it, and it's something that doesn't apply or we no longer have to do, but there's nothing else out there, I wonder, are we supposed to continue to use that guidance? Well, in this case, yes, we are. So Donald, I'll be emailing that to you. I got my answer this morning finally. So that's, you see stuff from 1999, 26 years later, and it still stands. So there's things like that out there. So this one is the determination of the recipient's administrative capacity to undertake the Indian housing program. There's another one about the existing policies that you have to have in place. That is that old also. So, just because it's old doesn't mean it's not the current policy. So when you get into code talk, you can go all the way back into history under your program guidances and your PIH notices. And it would be worth doing some reading, even though they're 26 years old, some of them. So determination of a recipient's administrative capacity to undertake the Indian Housing Block Grant Program. That's what that guidance has to do with. It talks about oversight responsibility, you having that administrative capacity to undertake affordable housing activities proposed in your Indian housing plan. That capacity includes the existence of adequate systems. So you have to have policies, procedures, all of those necessary components in place to run your program. And HUD has to agree, as well as your auditor, that what you're doing is, the best you can be doing. Oftentimes, you'll have an auditor come in and say, okay, you're taking in money. We had them say, we'd like you to put up child gates, the actual movable gates, so people couldn't get to the cash drawers in the great big horseshoe that the two people at the front desk that were taking money was at. You would have had to, they wanted them to go through the process of having to open that gate and putting dingers on the drawers and things like that. So I guess it's just to strengthen your program. So my auditors used to make me nervous at first. And I had a vice chairman who said, Cheryl, use your auditor. Call them up when you want to know if you can do something. Make them work for their money. Form that relationship and ask them. When you're wondering if you can do something, call them up and ask them. So that's what I ended up doing. And I was really, really lucky that I had good auditors that would, push me in the right directions, as well as ONAP staff. So the notice addresses determinations in administrative capacity. There's a separate notice, 2228, administrative requirements, that talks about investing funds and things like that, so your administrative capacity can actually be demonstrated by a history of satisfactory performance. Financial stability management systems which meet the requirements of, Part 85, policies and procedures that meet the requirements of the regulations at 1000, compliance with previous awards and funding amounts that you're given, organizational structure, development, operating policies and systems, and experience, which will actually minimize your potential for fraud, waste, and mismanagement of your programs. So that's what that guidance talks about. And it talks about having to have Indian preference and labor standards and environmental clearance and lead-based paint, making sure you adhere to that. Accessibility, Section 504, that Rehabilitation Act, flood insurance. So all those notices, all those requirements, we have to make sure that we have the ability and somebody within the organization is paying attention to. So your management, your capacity needs, the organizational structure, program development, management capacity, your capacity to administer, what type of funding sources you have, what type of programs that you bring in. Sometimes you think you're doing really well and you go out and you get monies from a different source, and then your requirements bump up against each other. The rule of thumb is go with the strictest set. When you get into the areas of like low-income housing tax credits versus NAHASDA, we have different rules about housing Native Americans, that will, kind of be in bump heads with each other. So you have to oftentimes call your funders and say, well, what do I need to do in this type of situation to make sure that I'm compliant? You have to have the capacity to administer from whatever funding source that you accept. You have to have that development capacity if you're going to build. And then once you build it, do you have the capacity to continue running it? The program management capacity, property management skills, and are you doing the self-monitoring and the compliance that goes hand in hand with that? Financially stable. Previous programs have been administered in an effective manner, which has maintained the financial stability of the recipient. The trends in your operating reserves, are you collecting your monies? You can't get a finding anymore for your tenant account receivables, but they will issue a concern, which you still have to answer. So it's just as bad. Get a good collections policy and you follow it, regardless of who it is. You follow that policy. If you don't collect your monies, you shouldn't be in the business, actually. So Your financial management systems, make sure you have them all in place. Financial reporting, your accounting records, your internal controls, your allowable cost. You need to know what you can legally spend and what you can't. No buying alcohol, things like that. Source documentation, cash management, your records retention. You're only as good as your records. You have to have a way to be able to retrieve that information. And then your budget control. Your development, your operating policies, managerial operation systems, have them in place. Make sure that they meet, the minimum standards. You're going to always go for more than minimum, but at least hit that threshold. Make sure you have those admissions and occupancy policies, your management and your personnel policies, your maintenance policies, travel, procurement, real property acquisition, relocation, conflict of interest in two different places. Conflict of interest in the administration of your contracts and in your admissions. It's grievance policy that you have to have 3 for. One for your tenants, one for your staff, and one for Indian preference. 3 grievance policies you need. Okay, so auditing and those audit requirements that you have to have, those are governed by 1544. You must comply with the Single Audit Act. So it's an expenditure, a total expenditure of federal funds of $750,000 during your fiscal year. So it could be from a different source, not necessarily just your block grant funds. That non-federal entity that spends $750,000 or more during your fiscal year, you have to have a single audit conducted in accordance with 200/14. So that, we talked about that yesterday. That governs everything finance, everything procurement, everything audit related, and contracting related. So that document, we have to make sure that, we understand that one also. You can do program specific audit elections when you, expend federal awards only under one federal program, excluding our R&D. It would allow for that. A program-specific audit cannot be elected for R&D unless all your federal awards expended were received from the same federal agency. So there were tribes years ago, 1992, so 30 some years ago at least, that allowed for biannual audits. If you should be one of those tribes and you were, given that privilege way back then, you still can let that happen. A nonprofit organization that had biannual audits for all biannual periods ending between July 1st, 1992 and 95 is permitted to continue to undergo their audits biannually. Okay. And then, is it an allowable expense? Yes, it is. But if you're a housing department, you can pay for the portion only to do with the housing. You can't pay for the tribe's complete audit. If you are a TDHE, housing authority, whatever you call yourself there, and you're the one all be all, well, then you can pay for the whole thing because it's only to do with the housing portion that is being audited. So the copy of that audit, does it need to be submitted to HUD? And actually the answer is no. You have to submit it to the Federal Audit Clearinghouse, pursuant to 2 CFR Part 200 Subpart F. Do you have to give it to the tribe? Well, yes, you do. They are ultimately responsible for all of the oversight. So they can carry out their oversight position. You need to make sure that they get copies of your audits. You also need to make sure that they get IHPs, APRs. Occasionally they should be getting your finance stuff, if you're under a board of commissioners. And if you have any HUD monitoring, you need to make sure that they are full aware of everything there and any type of findings that you have and your answers and all of that stuff. Okay, so development capacity. This lighthouse is used to be under the Federal Forest Service, and now our tribe actually kind of is the carekeeper of this, and this is like a couple of miles from my house. So development capacity. Do you have sufficient experience? Do you have capacity to manage your proposed development? So I started, the first one I did was a 15-unit project, 10-unit, 15-unit, because we used to compete back under the 37 Housing Act. And that's how I got my experience. When it got time to build a 100-unit project, I had a little bit more experience, but I still needed help. You know, there is a lot to do when you build that many units at a time. You have to also have all your components. You got to have your labor people in there, making sure that you're following all the regulations, your accounting. Accounting is a huge piece. You have to have good accounting people. You're only as good as your numbers also. And then the procurement portion, you know, so there's a lot of staff involved when you do development. I tried doing force account at different times. I used limited force account with contractors at also, you know, different times. So I've tried all the different methods, you know, over time. Smaller projects. I think the smallest I ever built was 10. Most I ever did was 100 at a time. It's always different. And the people that you work with, the more you build, the more you add on, the more their resources are going to have to be. Also, labor forces, you know, bankroll, things like that, equipment. So depending on what you're doing, that's going to talk about that development capacity. You know, do you have that required experience? Will third parties be needed to provide some of the services? And 98% of the time, yeah, you're going to need third parties of some sort, you know, whether it be your architect, your engineer, you know, different things like that. You'll need help. And don't ever be afraid to ask for it or pay for it. If they save you one mistake, you know, in your contracting, it'll be well worth it. That's, you know, what you have to, and then you can always use them as a learning tool. Don't ever be embarrassed. Don't ever think that, I don't know if I can do this by myself. If you're having that kind of thought, don't do it. Hire somebody and learn from them. Especially if it's been, you know, a while between projects also. So experience with multi-leveraged housing development projects, financial systems that track expenditures by funds, subtask, budget categories, understanding your community's needs and targeting your housing market. You should try, you know, at some point to find out what your tribal people want. What do they think they want for housing? Do they want all home ownership? Do they want rentals? Do they want rental houses? Do they want apartments? Do they want senior housing? I learned my seniors don't want to be in a senior apartment. You know, they wanted little houses with sheds. You know, do they want rehab? Do they want rehab for the old mutual help projects or for anything that you have on the res? You know, all those questions you have to ask. My res was split kind of in half at one point when I first started, and they used to call one part the farms because it was primarily farmland. And then there was a big church that sat on a corner and it divided the other half of the reservation, and we were called the mission. And the people from the farms didn't want to live in the mission. Now we have, you know, the majority of them here, and actually we're developing over on that side again. But it took years and years to get enough money for that infrastructure. You know, it costs a lot of money to build, especially when you don't have infrastructure in place. So understanding what the community's needs and target housing market is, and the willingness to manage your sovereignty in order to attract capital and investment. That limited waiver of sovereign immunity. My tribe, I watch, you know, and I still read the meeting minutes and all of that stuff, and they're waiving that all the time in order to accept monies to do certain things. So they have to be willing to do that. You know, your ability to provide various methods of assistance. Is it going to be a grant? Is it going to be a loan? Is it going to be a no interest loan? Is it going to be a market interest loan? Reduced interest? Are you going to allow sweat equity? Sweat equity comes with, you know, it's a mixed bag. because unless you have tribal members who are certified carpenters or electricians or whatever, most contractors don't want them on site. They're a liability. We let ours clear lots. We give them 1 acre parcels. Here, if you want sweat equity, at one time the mutual help program demanded it, and we ended up giving them the price of the 1 acre of land for the sweat equity portion. But we allowed them, to clear lots and things like that. I've seen instances where, they'll have them put together appliance packages, as a sweat equity portion. So there's all sorts of different ways you can work with that. Tools and equipment, you can, loan that out. Technical assistance, you can provide plans, things like that, or technical assistance. We found out we needed to put that component in once we started a mortgage project, because I was almost helping, we realized that our tribal people could get the mortgage, but they needed a general contractor or somebody on their behalf, getting all those tradespeople, taking all those steps, making sure everything was covered. It takes a lot to build a house all by yourself, especially if you've never done it. You have no idea about, how you make sure that you've got all those components in place. And so what would happen? Well, they'd turn around and we would end up doing it. It was too much with everything else we had to do. So, we would do packages with general contractors in mind that, had worked on the reservation before also. So those self-sufficiency services. So is, your staff versed in the useful life and binding commitment requirements? If you're spending over $5,000, make sure you got that stuff in place so you don't get a finding over that. And then you have that project management capacity, internal and external expertise. It depends on what you're building, how big it is, where it's going. Is it a turnkey project, or are you building from scratch? Are you using modulars? What time of year are you building? Are you on a crawl space? Are you putting in, full-fledged basements? I'm sitting on I've got a whole nother house underneath me, basically, because we have to go down so deep that we might as well go down the extra break and give them another living space. So that's the way we build on this half of the reservation. The other half has too much clay, so they're all on a crawl space. That's just the way it is. You've got to know your land and what you have available there. So you have to have that expertise. And if you don't have it, you hire it. The amount of experience, the level of expertise within your organization, and the availability of time to commit to those projects, because it all takes time. And who's on your team? You don't want to hear, well, that's not my job. That's not my job description. You need the most talented people you can get together to be part of that, So your areas of project development, your project management, project planning, project management, financial management, staffing coordination, your governing body communication, especially if you have a rollover in your tribal council. It's important to get in writing, basically, your marching orders. This is what we're going to be doing for the next couple of years. This is the area. So another one doesn't come in and say, no, we don't want to do that. You need those in your meeting minutes saying, this is the plan we're going to go toward, Get a grant writer if you can. Get you some money in there. And then, your intended project outcomes. So what is your internal capacity? Have you done that analysis? Do you have legal infrastructure in place? Do you have political support for your project and your location? Do you have sufficient capacity and knowledge to manage that particular project? Does your staff have the time to manage it? Do you have the right procurement policies and procedures? Are they sufficient? Do you want to look at the ability of raising those thresholds that we talked about yesterday? And do you have financial controls sufficient to support your project in place? And then you do the cost analysis, your construction budget, is it inclusive of all your costs, including that infrastructure and those fees? Always have a contingency allocation. You don't know what's coming at you. With contingency, I think of retainage. They go hand in hand in my mind. Never give away your retainage. Always keep enough to keep them on the job to do their punch list, or they will not come back. It's just, it's too much to mobilize. There's not enough money left. They already got a big enough chunk and they're gone. You don't want that to happen. The flexibility of your scope of work. So what's your sources, your uses of funds? Do you have funding availability? Do they have any restrictions on that funding? Do you have the sources of funds to meet or exceed your construction cost, your sales, your leasing, your expenses like that? Somebody's got to be looking at all those figures. Your operating costs, that pro forma includes all your costs. How much is it going to cost to manage it? What's your operating cost once it's up? How much operating reserves are you going to need? What about replacement? When you build a 20-unit project or 2 apartment buildings, 40 units, those roofs, those water heaters, things like that, those heaters, when they seem to go all at once because they're all the same age. You have to have some money in the bank to replace that. And debt service, you need an identification of subsidies, sources of subsidies. What are you going to use for funds? Or are you going to go back to the tribe? So those are all things when you decide that you're going to build, you have to have answers to all of those questions, or at least be searching for those answers before you push forward. It's a big job. Building is a big job. So, the next part, of course, is your eligibility, your types of families that you're allowed to serve, and the requirements to serve those tribal members. So this is on my side of the res, and that's Canada. That's how close we are. And you can walk right across, and that's, my grandfather used to do that a lot. I walked around there a few times when I was little. So your program recipients, your eligible families, mandated NAHASDA eligibility requirements. Okay, so those income limits, like I said yesterday, should be coming out very soon. I think they came out in April last year. I've seen them as late as June, but I started looking for them last week again. So your gross income has to be within those defined income limits. There's special exceptions that apply. It's supposed to be Native American. Congress gives us the money for low-income Native Americans. There's special exceptions there also. And you have to deem them suitable for your housing programs. I remember the first time I saw the HUD definition of family. I thought, everybody's a family under HUD's definition. Includes a family with or without children, elderly family, near elderly family, disabled family, or a single person. They can be low income natives. They can be non-low income natives. They can be what you call an essential family, or they can be a law enforcement officer that meets certain conditions. You can serve in the low income Indian family as long as they are within your Indian area, and however you're serving them, the activity and that area is described within your IHP for that year. Again, that definition's 80% of median income, the greater of your Indian area or your U.S. median income limit. So if you're in one county, you just compare your county to the U.S. median income. Whichever is higher is what you use. In the case of my sister tribe, my husband's tribe, I think they're in, 8 counties. And you take all the counties that you have properties in, and you take the highest one of those and then compare it against the U.S. median income, and that's what you use for the year. So that's how you come up with that amount. And you should be doing that. It's coming up shortly. So people that, making up your family, Indians, there's non-Indians, elderly, near elderly, disabled, your single member or sole member of the family, a minor, or a student. When it comes to near elderly, okay, I'm a near elder. I'm not 65, but I'm considered an elder here on the tribe. You have to also decide your definition of elder and at what point they become an elder for your deductions. So make sure your policy addresses that also, okay? If you're a near elder, are you going to get the elder deduction? Because it causes certain things to happen. So our low-income Indian families are the primary beneficiaries in NAHASDA, as long as that annual income does not exceed 80% of the median income for, the greater of the county or the borough that you're in, or the U.S. median income. And you have adjustments for how many people are within your household. And then you have to make that determination, or your executive director does. Are they suitable? Are we going to serve them within our program? Do you run a criminal background check? Okay. That's a discussion you have to have with your governing body. And it's not, I'm going to run it on him because he looks like a criminal. It's, if we're going to run a criminal background, we run it for every applicant that puts in for housing. And then we run it for every person that wants to move into a household that's already here. We actually did that with transfers too. If we would run the criminal background on them if they requested to transfer units, but you got to make sure that's you're in your A&O policy, that's when you're going to do that. I was surprised, I had ran criminal histories on them when I put them into a unit, and 15 years later, they had this criminal history. They've been a tenant the whole time, but I didn't know about it. Wouldn't have never caught it, except for they tried to transfer units. So your unsuitability, you need your criteria. You need to decide about that. What about, are you going to run the criminal lien? Are you going to accept a violent criminal background, drug-related criminal background, poor history related to previous housing? If they've trashed your houses as, a tenant, are you going to let them back in? And are they in debt to your tribe or your TDHE? We would not allow someone that owed the housing authority to put in for any other program offered by the housing authority until that debt was paid in full. And then you may need to make a determination. Are you going to service them or allow them to live in one of your units with somebody else? You owe me $35,000. You already trashed one of my units, You have to look at all of those pictures, answer those scenarios, So Section 4 of NAHASDA defines median income with respect to an area that is an Indian area, the greater of the median income for the Indian area, which the secretary shall determine, or the median income for the United States. So this is a trap net. We have, like Alaska, we have a lot of fishermen in this community. It's very exciting when it comes time to figure out the taxes, because they have treaty-related incomes and they don't file taxes. So I would find myself almost negotiating with them. Come on, if you only made that much money, you'd be working at McDonald's. You made more than that. And that's what you'd have to do to be able to get those incomes, because there's really no way when they don't pay taxes like that you can prove how much they make. So it's interesting. I used to reach out to my colleagues in Washington State and those area that had treaty fishermen also. And that's what you do. You find somebody else in the U.S. with the same kind of problem. And how do you do this? So your median income, they change. Okay, so it was published April 26th. Today is the 22nd. So maybe we'll see it, this week, next week, or it could be, like I said, as late as June. But those income limits are coming soon. That's when it came out last year. Okay. If you have, like I said, lands in more than one county, you have to look at the median income for every county. You just have to do it once for the year and then establish that's what we're going to use. An Indian is defined by NAHASDA as a person who is a member of a federally recognized tribe or a state recognized tribe of which that tribe has met certain conditions to receive funds under the 1937 U.S. Housing Act. And our tribes, they determine their own membership, their criteria, and their eligibility. So that's what you'll be looking for to come down the pipe for the income limits coming out. That was the latest one that came out. And like I said, start looking because it'll come out soon. You also have to, in your A&O policy, say how you're going to charge your rent. And you have to address the 3 annual income definitions. There's the census definition, the IRS definition, and the Section 8 definition. And if you use the Section 8 definition, those thresholds, there's changes in there that's happening. And supposedly we were supposed to have until December 31st to have brand new A&O policies out, changing our definitions and deductions if we used that particular definition. I would suggest that if you are one of the tribes that use the definition, we will utilize any one of the 3 definitions, the one that is most advantageous to the tribe or to the participant, that you no longer use that definition. Because when it comes down to monitoring and things like that, they're going to make sure that you ran that income all 3 ways. So you're tripling your work, okay? Not only do you have to make sure that you ran it all 3 ways, you have to prove that you're consistent in your selection. So you're opening yourself up to a little bit, possible findings. Why'd you do it this way? Why did you use the Section 8 instead of the IRS definition? Things like that. But regardless, when it gets to Section 8, if that's the one you utilize, or you use the definition saying that you're going to utilize all 3, your A&O policy is going to have to be completely redone and reapproved by the end of this year. Okay, it was supposed to be done by December 31st. We just got another extension, okay, until December 31st of this year. But you're going to have to redo your whole A&O policy if that's what you do. So just be aware of that. The IRS definition, okay, that's the only definition that basically allows monies to come from the tribe to your participants. That doesn't count. Not really per cap, but, monies to live on. I'll have to think about the exact term that's used, but that IRS definition is the only one that will allow for that, okay? So median income. The median income for our program is defined as the greater of, your income limits, whether it be your county or the U.S. median income limit. You take the highest one and qualify as many of your tribal people as you possibly can. Slides along the scale dependent upon how many people you have in the household. Now, if you use somebody, 5 people household, and one of them's away at work or one of them's away at college, but you're using them to slide up that scale, you have to count their income, whether they're in the household or not, because you're counting them at this point. So the median income limit is $97,800. So that would be the family of 4 at 100% of median income. We have to fall between the 80 and 100%. So that would knock us to $78,240 here. Okay. So those requirements, Section 4 defines median income with respect to an area that is the Indian area, whatever the greater of those 2 amounts is, the county or the U.S. So you need to, finally, that language was updated last year. Those are in your reference materials. It shows you what you need within all of your policies and procedures. The first thing you do is you adopt the income definition for your tribal housing policies. We're going to use the IRS definition. We're going to use the Section 8 definition. We're going to use, the census definition. You're seeing a little bit more of the tribes go to the IRS definition lately. NAHASDA exclusions. Okay, so we have those statutory exclusions, those federally mandated exclusions in there, and then the ones that are adopted by your governing body. So should you be one of those tribes that say, okay, we want to make it a little bit more affordable for our tribal members. Rather than a $400 deduction, we'll give them a $600 dependent deduction. If you do that, that needs to be in your IHP as well as your A&O policy. That along with the $400, we're going to give an additional $200 to make a total of a $600 dependent deduction, and you need proof, the meeting minutes that instructed you to do that or allowed it. Always keep proof. Your auditor, your HUD people, they will say, show me in writing where it said that you can do that. So you always keep proof. When they tell you to do something, you say, okay, could you put it in writing for me? Because I need proof. A lot of people don't like putting things in writing. And you you hold your HUD people to that too. Could you please put that in an email for me and print it? I don't know how many times I've seen situations where they can't retrieve the email 4 or 5 years down the road. Print that email, stick it in that file. Okay. Just cover your 6. So you have your NAHASDA exclusions, your federally mandated exclusions. You have to do those income verifications. If they don't want to do it, you ask them to leave and you find another tenant that will. So you make sure your admissions and occupancy policies state they have to do the inspections, they have to do the verifications. If they don't want to, that's grounds for termination of that lease. And then you have the adjusted income for purposes of determining that rent. So it walks you through basically in this guidance that came out last year, how you do it. Your eligibility, you have to use one of the 3 definitions of income there. Make sure your A&O policy says which one you're using. And it speaks then to the exclusions of income. There's Social Security, there's different disability, deductions. And the good thing about this is it used to go back to 2011 and other notices. This is a brand new document that came out last year that's up to date. Keep a binder with your A&O stuff so you have that. You might not have somebody from your tribe that's eligible for that, but there's a deduction in there that I qualify for. I get money on once a year as a result of a land claims. Okay, it relates back to the land. We get the income derived off of the monies that were put into a trust for the tribe on a yearly basis. And the first $2,000 of that money is exempt. Okay. So, you might not have that at your tribe, but if I come and marry one of your tribal members or move into one of your units, then I would be eligible for that. So you still need to track all of those different deductions and be aware of them. So the most recent federally mandated exclusions were published January 31st of last year. So at least they're not 15 years old like they were. It's brand new and it's in that attachment. Make sure you guys have that. Okay. And then you do the income verification. You have to decide, there's 3 forms of verification that you can do basically. HUD comes from the public side, basically doesn't like hand carried information. Okay. They would rather you contact the employer and that your participant not touch anything. Okay. I did not have a hard time. I would take check stubs and things like that. You just make sure that you have all of the check stubs, everyone for the payroll weeks, so that there was no chance of it, missing. If your tribe is a big employer, make it with the tribal council that, human resources will give you the information. We would contact human resources. Are they employed? How much have they made? What's their hourly wage? How long they've been working? Can you let me know, did they get a raise or did they get fired or, and it's quick to get that information and it comes from a different source. So that's another thing that you can work to do, so use those different verification methods. Third-party income talks about tax returns, W-2s, pay stubs. I had no trouble taking, that type of information. So for your adjusted income for purposes of determining rent, You have youth students, persons with disabilities, you have the deduction for that. The elderly and disabled family, there's a $400 deduction, has to be elder or disabled family. The caveat about that, and where there's a lot of slippage, is if Donald and I are married and we're both 45 and his mother lives with us, we're not an elder family because we're both 45 and we're the head and the co-head, okay? If we're married and we have a disabled daughter, we're not a disabled family because Donald and I are not disabled as the head and the co-head. That's the way it goes, okay? So you have to make sure that you understand how those deductions work also. You have medical and attendant expenses, childcare expenses to enable someone to go to work. Caveat there is you can't pay $900 or allow for that deduction of $900 worth of childcare, and they only make $700 making fry bread. They're only allowed $700 then in that case. The earned income of minors doesn't count. Travel expenses, $1,300 a year per family, not per member. You set the perimeters. You have to have a travel expense policy. How much is excess travel? And, any other amount you put in your IHP and your A&O policy. So Section 203 in NAHASDA requires that our grantees develop written policies governing the rents and homebuyer payments. It's got to be in that document to make sure that our people are eligible, that we're uniform and we treat everybody fairly. That's the biggest, that's the biggest thing they look at. They want you to treat all of your tribal members the same, fairly. And you can't charge them over 30% of their income. 30% of zero is zero. Okay, so you got to make sure, you do that. So there's a final rule about HOTMA. As I said last year, EWONAP was supposed to be developing the guidance and training to help our tribes and TDHEs that use that Section 8 guidance and training definition to make sure that they have the adequate policies to implement those new rules and those new deductions. It said they'll be in touch with more information in the near future. It gave, basically January 1st, 2024, we're supposed to kick into action there. And then we got an extension. Okay, so let's see it. There's PIH notice 2023-27 on HOTMA. They let the PHAs set a compliance date between January 1st, 2024 and January 1st, 2025 to come into compliance. And then they turned around and said, HUD's going to publish additional EWONAP program guidances covering the revised Part 5 definition. And then we got the new one. And now we have until January 1st of 2026. So sometime this year, it's going to come out. You're going to have to redo your A&O policy if you utilize the definition for Section 8 or the definition saying that you're going to use all three. And it plays with some of the deduction amounts also. Okay, so we'll get to you on that one. So whose income counts? Your head of your household, everything counts. Their employment income, any other income they have. Same thing for the spouse or co-head. Other adults, yeah. Dependents, their employment income does not count if they're under the age of 18. Any other income they get counts. Live-in aids, you count nothing. Foster adults, you count their employment income, but you don't count any other income that they have in. And foster children, this came over from public housing, and you see some tribes address this. Okay, this is one of the areas where your governing body can make a decision if they want. For instance, our children, our Indian children, we take them in. Whether it be grandma, auntie, sister, somebody's going to take them in. Now, I've seen a lot of places where we think they should receive the dependent deduction if you bring them in and you're taking care of, your granddaughter or niece or whoever it should be, and they're a minor. So what they'll do is they will make an exception rather than call them a foster child. They'll perhaps make a policy that says any child under the age of 18 living in the household 3 months or more, or 6 months or more, or whatever they decide, will be eligible for the dependent deduction. And that would allow you to, give them that deduction for the year. That's up to you. Then you put it in the IHP, you save the policy or the meeting minutes with your policy, and then you put it into the A&O policy. It's just got to appear, or you have to have, all that tracking and it appear in both places. But that's how you do it. And it's sometimes done that way because, we take care of our children. That's just the way it is. And we don't necessarily make them foster children. So the earned income of a full-time student 18 years of age or older who is not the head, co-head, or spouse is excluded to the extent that it exceeds $480. I don't know if I have that in there. So the way that goes basically is Donald and I are the head and co-head. We have a 23-year-old son who is a full-time student. We're going to give him a dependent deduction of $480 because he's a full-time student. Then he's got his stuff together. He wants to make some cash. He's got a gig and he makes 30 grand a year. You take back the first 480 he makes from that dependent deduction. You charge him that 480, and then the rest of it slides. You only count the first 480 because he's a full-time student and he is not the head or the co-head or sole occupant. Those are the rules for your full-time students, okay? So, and then you have to make sure that you look at all of those VA benefits and all the deductions that are listed within that guidance to make sure. Live-in aid, you don't count anything for. Now, there's been over the years a little bit of a different thought there. A live-in aid used to be someone that would leave once the person that they were caring for was no longer there. Over the last 10 years or so, there was a lot of programs that would allow family members to get paid to care for other family members. And they almost took the part of a live-in aid. And there was a salary coming from that. Now, if you interpret it that way, and, your 26-year-old daughter is living in the house taking care of mom, and she's getting paid, and she works or whatever, but she's the caregiver, you could be in that situation where you have to look at waiving all of that. So that's, an area where you have to pay a little bit more attention because the rules have changed a little there. So income from self-employment, your cash assets withdrawn or salaries paid to household members from businesses have to be counted. Losses are counted as zeros. They're not deducted. Alimony and child support. Okay, the rules for that. You go to the court of jurisdiction if you're supposed to receive child support and you're not getting it. You have to actively try to get that child support. So you go to the tribal court and, Johnny owes you $200 a month and he hasn't paid anything. Well, it's not fair to charge her $200 a month for that because she hasn't received anything. She can go to the tribal court, say, hey, can you try to get this money for me? And at least can you write a note to the housing authority saying that I am actively trying to pursue getting my money? And then you don't have to charge her for that. Okay. So if it's not received, you document that delinquency, and that they were trying to get it. There is no asset limitation. You count the income derived from the asset, not the asset itself. Okay. So A&O is a couple of day course, but you should probably take that at some point. You need to know, especially if you're a director or the assistant director, how that works. Okay. So there's different times when your family has to be low income. For rental housing, it's when the lease is signed with the family. When it's a home ownership program, it's when the mortgage is signed with the family. If it's rehab, when the agreement is signed with the family. And if it's rental assistance, it's when that agreement is signed with the landlord. Rehab, make sure you're checking for lead-based paint. Make sure if they're getting over $5,000, you have a useful life policy, and make sure you pay attention to the insurance requirements. Those are the areas that will get you in trouble. And if your participant should happen to be between 80 and 100% of income, they can't receive the same if you give $10,000 out in rehab, okay? And then you got a participant that's between 80 and 100%. They're not allowed to receive the full $10,000. You cannot service the participant that falls between 80 and 100% with the same amount that you would service a low-income person. So when it comes to rehab and down payment assistance, there's a formula that you actually run that is in that guidance, and I'll teach you how to do it there. And they would get a reduced amount, okay? So you don't give them the full amount either. Those are the things about rehab. There's slippage in those areas. So types of families based on income, you have low income Indian families. If you would like, and your governing body wants to, you are allowed to service 10% of your grant amount. Okay, and they call it the 10% authority of families that fall between 80 and 100%. Those are the ones I was just talking about, okay? You have to put it in your IHP. You have essential families, you have law enforcement officers. You can serve any low-income Indian family within your Indian area as long as you put that activity and the area in your IHP. Definition again, 80% of less of median income or the greater of the Indian area or U.S. median income limit. How many low-income Indian families? Up to 10% of your grant for 80 to 100%. It's your 10% authority, and you have to track that authority. If it's under 10%, there's no other HUD approval needed besides to make sure that it's in your IHP, okay? Track the authority. You could get down to the last family. They need $6,000 and you have $5,000 worth of authority. You could actually ask HUD, can I service them? You ask them in writing, and they could allow it. You know, well, yeah, you can use another $1,000 and service that family. If it's more than 10%, that HUD approval is required, you know, that 10% of authority. That's why you're tracking it. If the family, if their income is greater than 100% of median income, you always need HUD permission before you assist them, okay? Have to show a need for housing that cannot reasonably be met without your assistance, okay? You build your criteria for your moderate income families and your essential families. And depending on where you live, it's sometimes not that hard because you're the only thing in town. You know, there is no other rental properties available. Or you put criteria in there that the family wishes to live within the Alaskan village or the Pueblo or the reservation. You know, they don't want to be out on non-tribal land. And then the non-low income family and housing assisted under your 1937 Housing Act for continued occupancy, you're going to have to address that in your A&O policy also, okay? Came in, they were low income when they got here. They did what every tribal member you hope happens, and they got a better job and they did better. You have to decide, your body has to decide, are we going to continue to service them? Well, if you have, you know, fair market houses or you have housing stock within the tribe that they can go to, some will say no. You have 30 days, 60 days, go in and put in for a different household where you're going to pay some more money. We want this for our low income housing. If you don't have that there, you'll have, you know, some tribes that say no, you know, let's just let them stay here. So you need to make a decision. Are we going to make a move? If we don't make a move, are we going to charge them more? Because you can now charge them more money because they're no longer low income. Those are your decisions you have to make, and you have to address those in your A&O policy, okay? Make sure it's in there somewhere when you review your policy. You should be looking at your policies once a year. So that's under continued occupancy. You can read about it at all these different parts within the regs, you know. Subsequently, you know, home ownership is a little bit different. So the rules, it includes a family member or household member who subsequently takes ownership of a home ownership unit, for instance, by inheriting that. Whether or not they can receive the same benefit as your low-income family is subject to your admission and occupancy policies. Those families don't count toward your 10% authority in the number of low-income people that you serve, so you wouldn't have to track them, okay? I don't want to call them aging in place. They're just kind of improving in place. Okay. And then you have your essential family. So you need policy addressing that in your ANO also, you know, your essential families policy. That notice goes all the way back to 2014-02. And it describes, you know, criteria and rationale for determining if that family is essential. It has to be within your policy who's going to make that determination. Okay. I was allowed to do that as an ED. I've seen places where Board of Commissioners do it, and I've seen other places where the tribal council say, we're the only one that will deem someone essential living in our properties, okay? Essential, a lot of times can be used, you know, for your doctors and your dentists. You know, I had that discussion. I was at the dentist yesterday. We had fair market units. We had other units here that when I was here that we established, and now we actually have a couple, they call them provider units. And those are for our doctors and dentists, because if we don't provide them housing, we're not going to get doctor and dentist up here. We've got great dental staff and people like that, but they have to have nice places to come. It's hard enough to convince them to come up where it's winter 6 months a year. Seems like 5 months a year anyway. If you don't give them a nice house, they sure aren't coming, you know. So we have what they call provider housing here. But you have your essential families that you can assist this way also. Doesn't require HUD approval. You can serve them if you can deem them essential to the well-being of your Native people, your Indian families, your low-income Native people. And if those needs cannot be met without your assistance, if there's no other place to put them, you know, you have to have that essential families in your eligibility and your admission policies. Make sure that your policies address if they no longer deem them essential. You don't want to put somebody in as a dentist and have your sister tribe hire them away for more money and then them want to live here because you've got nicer housing. Nope. You're no longer essential. I'm sorry. We said, you know, that was in your lease that we can deem you no longer essential. So have an essential families policy. You know, your inadequate housing can be pet infested, fire hazard, lacks energy efficiency, it's overcrowded, there's no heating, there's inadequate cooling. You build your criteria. A determination that housing need cannot reasonably be met. There's no rental housing in the area. There's no affordable housing in the area. Inadequate housing stock in area. Family desires a residence in an immediate area near their family. Housing stock is insufficient. So you build your own criteria. You just have to make sure that in every file that you do something like this, you have proof, and this is the reasons we place them here. And then documentation, you know. You have affidavits from the family, you have payroll stubs, you have rent receipts, rejection letters, denial letters, code violation, you know, whatever that be. And then what are those requirements? You know, your criteria for essential could be, you know, anything others, you know, as determined by the executive director. Or they could be a dentist, school personnel, medical personnel, firemen, employees of the tribe, spiritual leaders, military personnel, you know, whatever criteria you put in there. And then the law enforcement, it's got its own criteria that you have to follow also. So Section 201 of NAHASDA, the statute, allows us to house people under our law enforcement provision. There are certain criteria that you have to meet. You know, they have to be an arresting officer. They have to be employed full-time. You know, so the criteria there must be employed full-time, federal, state, county, tribal, or other unit of local government, sworn to uphold and make, you know, arrest So they have to be an arresting officer for violations of federal, state, county, tribal law. In addition, the program must determine the presence of that law enforcement officer may deter crime. Law enforcement officers can receive the same benefits as low-income families, and they do not count toward the 10% authority. They can also be non-native, as well as the essential. Those are the only two ways that you're supposed to house a non-native, because the money is given to us for the benefit of low-income Native people. And I have seen findings, because I go out and that's, I help write policy. I help people prepare for HUD monitoring. I go in after the fact and help them close monitoring findings. And I have seen findings for non-native people within housing that were not essential and were not law enforcement. You will get a finding for that. So make sure you don't. Your law enforcement officers, you can charge them more if you want, but you don't have to. They deter crime. So we use this provision, we have law enforcement all over here. Yeah, crack one corner, there's a state police detective next to me. Crack the next corner and there's, Bay Mills conservation officer. And then you'll see a Bay Mills police officer, and we have a sheriff over and we have in our fair market housing several state police officers from the post that's 20 some miles away. Why? Because we have nicer housing than anybody in the county. We've always taken, really, really good care, and we're proud of the housing that we offer. Put those squad cars out there where people can see them. It's a deterrent. That will deter crime. Now, let's go to a different area than this one, because unfortunately, our reservation areas are some of the safest placed for non-native criminals. They have to break, federal law, and it has to be a big enough offense to get, the attention of the appropriate law enforcement. So don't let that happen. Use, a provision like this. So references, families of eligible for affordable housing activities, low income, non-low income in accordance with 110, and a family can receive that housing assistance on a reservation or Native Alaskan area if the housing needs cannot be reasonably met without such assistance, and you as the recipient determine the presence of that family on your reservation or Native Alaskan area is going to, be essential to the well-being of your Native American and Native Alaskan families. So what's HUD going to look for? They're going to look for your program files, show proof that the family was low income at the time of admission. That's one thing, by the way. You have to keep proof that your family was low income when you let them in there. And if they're there 20 years, you leave that proof and you move it into their new file. If their file gets too thick, you have to keep that proof there forever. And I've got a monitoring finding for somebody they put in 10 years before I took the job. Luck of the draw when they do those monitorings. They do 10% of your files. So always during your self-monitoring, make sure that you have the proof that they were income eligible when you let them in there. And then if you prove that they're not, you say, okay, we discovered this in self-monitoring, put a big old red piece of paper on the front of the file. How'd you correct it? We took an A&O course. Then hopefully you won't get a finding on that, okay? So if they're not low income at the time of admission, do you have proof that the need for that housing cannot reasonably be met without your assistance, or the family meets the definition of essential family or law enforcement? Is there proof the family meets all the requirements under your approved policy and procedure prior to admission, okay? And move that proof of eligibility from file to file. Okay, so some of those statutory deductions, because you got to make sure that they're income eligible if you're serving. And then your other program assistance for your non-low income families. So what is your adjusted income? Your family's payment is based on a percentage of income. Their annual income first needs to be adjusted. Your annual income minus those deductions that we were talking about, or we're going to talk about, equals that adjusted income. It's derived from subtracting any of those 5 statutory deductions and any that you have adopted in your A&O policy and IHP and have in place, okay, that apply to the household from the household's annual income. The household's eligibility for deduction depends on what type of household it is. Special rules, okay? So when you we were talking about Donald and I, and our disabled or your elderly occupant, it depends. And sometimes you have to be the head of household, the co-head, or the sole occupant to be able to qualify. In other circumstances, you can't be the head of household, the spouse, or the co-head. So it depends, what role you play in that household. So the $480 statutory, we'll call it a dependent deduction. Children under the age of 18, disabled persons over the age of 18 who are not the head or the co-head, full-time students over the age of 18 who are not the head or the co-head or sole occupant, $400 for an elderly or disabled family, attendant care expenses over 3% of annual income for any type of family. Okay, remember, attendant care, any type of family. Medical expenses only if you qualify as an elder or a disabled family, and that's 3%, over 3% of the annual income. Okay, so that elderly disabled deduction, 400 elder or disabled deduction, should only be allowed if the head, co-head, or spouse is 62 years of age or older, or the person with disabilities. Okay, unless you change your policy for your near elders. Make sure, because I get in there and I start reading a policy and then, okay, we got near elders at 55. Okay, well, what about them? Did they qualify for the deductions or not? You have to speak to that. They will not be eligible for the elder or disabled deductions until they reach 62 years of age. Or they are eligible as a near elder at the age of 55 and older. You have to say one or the other. You just can't say they're a near elder. Well, what about being a near elder? Check that to make sure that you've got that addressed. Statutory deductions, childcare expenses that enable a family member to work or to go to school, not to volunteer. Okay. Earned income of minors under 18. Travel expenses not to exceed 25 per family member. No, Scott, per family, not per member, per week. Sorry. Other exclusions provided for in your housing policy and your IHP. The deductions are applicable regardless of which method of calculation of income you are using. You have to give them all those deductions. Should have policies, should have a child care policy, should have an essential families policy, should have a law enforcement policy if you're going to address that. You should have your 10% authority, your, over between 80 and 100% of median income. You should have, your excessive travel policy, all of that. You need policies for every one or a component of. Okay. Does not qualify as a dependent. The head of the household, the family, the spouse, or the sole occupant can never be considered a dependent. Okay, so those are, you can't be if you're in this situation. A foster child, an unborn child, a child that is yet to join the family, or a live-in attendant may never be counted as a dependent. Those in the household who are under the age of 18 qualify as a dependent. A full-time student over the age of 18 can qualify as a dependent if they are not the head of the household, the co-head, or the sole occupant. So those are your rules for your full-time student. 480 statutory deduction for a full-time student over 18 if they are not the head or spouse or sole occupant. In that case, you'd have to count their full income and you wouldn't get the dependent deduction. And then there's the rules for their work. Count the first 480 and you don't count the rest. Okay. And then if they're living away from home, and as I said earlier, if you're counting them to move your way up and down that bar. You know, if you're working, you have to count their income if they're gone. If they're in school, you have to count their income if they're gone. You know, it depends. They also think that that full-time student should be counted as a dependent on the parent's tax return. So my son started working full-time the day after he turned 15. That's how old it was on the res. He was allowed to go to work. I don't think he was probably 18, 19, if it wasn't even earlier, that he started filing his own taxes because he could make more money doing his own than being online. But we didn't live in housing, so I didn't have an objection to that, but you might, you know, and your tenants might. So it depends. Have a full-time verification form. You know, that's one thing. We don't have a lot of forms and things out there. You can always go to the public housing side and then try to convert them to something that we can utilize. Or go to your regional meetings and ask, hey, has anybody got this? That's the best way to get stuff. So my niece, my nephew, great niece, great nephew on Halloween, boy and a girl. So childcare expenses enable that family member to be gainfully employed, further their education. The amount deducted should not exceed the employment income. Remember, if you're making $700 making fry bread, you can't charge $900 for childcare. The amount is not paid nor reimbursed. Child care expenses incurred to permit a family member to work must not exceed the amount earned by the family member made available to work during the hours for which the child care is paid. You should address, you know, you're going to pay child care till they're 12 or whatever the age be. You should have a policy, you know, addressing all of that. You're not going to pay child care from 9 to midnight every night when the person works from 10 in the morning until 2 o'clock in the afternoon. You know, it's got to match up. The hours should match up. They also say that there should not be somebody over the age of 18 in the household capable of watching them. You have to use some common sense there. If you've got another sibling in the household, they're working at the casino till 2 o'clock in the morning, and you need childcare at 7 o'clock in the morning, they can't watch them. They need their sleep, you know, so you got to use some reasonable thing there also. I mean, if they're out there working too, they can't be providing childcare during their sleeping hours. Should have childcare verification form, you know, who pays it, how much they're charging, whatever. You'll see some kickback once in a while. Should the childcare provider be one of your tenants who isn't claiming that income? Sometimes it bites them. Excessive travel. Got to have that policy for the benefit of families who travel long distances to and from work or school. So our reservation is 20 to 25 miles from the nearest town, from groceries and things like that. But we have a community college. There's also another college there. And besides, if you work, you know, for our casino or on the reservation, that's the other big employer. So we use 20 miles one way for the allowance. But you build your criteria, you know, make it so they qualify for your next nearest town. Make sure you have your criteria and policy. $1,300 a year max per family, not per traveler. Okay. So when it comes to calculating that maximum payment, annual income minus their statutory deductions equal their adjusted income. Their adjusted income is then multiplied times the 12 months of the year. That's their monthly adjusted income. Their monthly adjusted income is multiplied times 30%. That is the most you are allowed to charge them. Okay, that's how you come up with the 30%. So make sure, because sometimes there's not a lot of money left. Okay. Deductions based on the type of household. If they are an elder and disabled household, okay, if the head or co-head or sole occupant is an elder or they are disabled, they qualify for everything. If they are not an elder or disabled household, they don't qualify for the elder or disabled household or the medical expenses in excess of 3%. Okay. They qualify for everything else. And then for serving your non-low income families, essential, you do not need HUD approval. You do not need to charge them more, and they don't count against your 10% authority. Same thing for the law enforcement provision. Continued occupancy. You do not need HUD approval. It's determined by your policy if you're going to charge them more, if they, get that increase in their household income. And they don't count against your 10% authority. Your families between 80 and 100% of income do not require HUD approval as long as you haven't hit your 10% authority threshold. You do need to charge them more, and they do count against your 10% authority. Should you want to exceed the 10% authority, you need HUD approval, you need to charge them different, and you're exceeding your cap. If they're over 100%, you need HUD approval, no matter what, up front. You need to charge them more, but for some reason, they don't charge against your 10% authority. And I don't know why. That makes no sense to me. So your housing need for your non-low-income families, they have to have that need that cannot otherwise be met without your block grant assistance, okay? You assisting them with your funds. When they, reside in inadequate housing, when they are in temporary housing, if they pay over 50% of their income, including utilities, you can utilize that funding for up to 10% of your grant amount. If it's more than 10, you got to ask for HUD's help or permission, not help, and if they're over 100%, you have to ask for permission. You submit a proposal to provide assistance to non-low-income families as part of your Indian housing plan. Request to the proposal as an amendment to your IHP, or you can, submit the request to HUD. So all of that is governed by the PIH Notice 2014-02. That will tell you how you run your formulas. That'll tell you law enforcement. That'll tell you essential families. That'll tell you the 10% authority. That is the document you need if you want to help people that are more than 80% median income. Some of those policy, things for building those requirements, property inspections, evidence of living in temporary housing, verification of family income, rejection letters, lenders or landlords, letters stating the family doesn't qualify for any other federal, state, or local housing programs. And then you have a moderate income checklist. So you'll have essential families one, you'll have a moderate income one. You need proof for every time that you assist somebody, and that's how you generate your proof. Income and assets are insufficient. There's no mortgages available on the trust land. The Section 8 waiting list is too long. The family desires residence on a reservation or within the village, and your documentation and things like that. The rents, including a home buyer payment under a lease purchase agreement to be paid by a non-low income family, cannot be less than the income of your families that are low income, okay? But need not exceed the fair market rent or value of the unit. So you have to run a calculation. You can run the calculation that's outlined within the document, or you can charge them fair market. Fair market seems to be always the higher amount. You have to be consistent. You can't do the fair market for one person and run the formula for another within the same program. Now, if they're different programs, you can't. So you have an example, 80% of the median income for a family of four in Seattle, $75,040, okay? The rental payment at 80% of median income is $1,200. The fair market for a 3-bedroom is $1,793. See the difference there in the cost? So this is how you would run their formula. The income of your non-low income family is $88,000. You divide that by the income of your low income family, and they're at $75,040. That comes out to 1.17. You multiply that times the low income rent. So the rent at 80% is $1,200. You would either charge them $1,404. Okay, that's the formula, or $1,793, which we discussed was the fair market value for that unit. That's how you figure out how much you charge your non-low income families. But there is a formula for doing that. Okay? Should be addressed in your policy. Make sure that somebody's tracking your authority. So if you have $365,000, grant a year, only 10% of that's $36,500. So that's what you would have, available for that 10% authority. You have one family, you're giving them fair market rent, $698 a year. That comes out to $8,376 in assistance. Your second family, you're helping them with home ownership. $850 times 12, that's $10,200 of your NAHASDA assistance. And then you got your third family comes in and you're giving them down payment assistance. They qualify for $7,400 because they don't qualify for the full 10 that the other families would get. That leaves you $10,524 of NAHASDA funds for eligible use for your next family. If you come in, and you have a family that needs $11,000, you have to get a hold of HUD and say, I'm a little bit, shy of $500 assistance to be able to help this last family. May I assist them? You put it in writing and they either say, yeah, you can use your funds to do that, or no, you can't. But you have to make sure somebody is tracking that. So the same thing where the other amounts of slippage is when you're providing modernization, when you're providing rehab, any of those other programs, and you're assisting somebody between 80 and 100%, you cannot give them the same down payment assistance. You can't give them the same amount of assistance as you are your other tribal members. And we often have people that don't think about that. They don't think about, we can't give them that same amount. We're giving, $20,000 worth of down payment assistance. Whoever needs it, No, if they fall between 80 and 100%, they don't qualify for the full 20,000. Or you're going in and you're doing a rehab. That's not one of the houses you built. You got to make sure that there's no lead-based paint in that house. You have to make sure that they're going to be able to provide insurance if you're assisting them with over $5,000. You have to make sure that you have a useful life and binding agreement on that household. So those are the areas where we have huge slippage across Indian country. Make sure your programs address all of those things, okay? So same family, $75,040. We're given $10,000 in down payment assistance, okay? So they cannot, the max assistance, you take the income of your low income family at $75,040 divided by the income of your non-low income families, $88,000. That comes out to 0.85. Take the 0.85 times the $10,000 worth of down payment assistance you give everybody else. Your non-low income family would only qualify for $8,500. So make sure that somebody's running that also, that you're not giving them more assistance than what they're legally entitled. So HUD's going to look. What do they check for? If they're non-low income, is the participant paying the appropriate rate up to fair market value? So your last module, and I'm running a little late, is your eligible affordable housing activities. So you can give help. You can spend your money on Indian housing assistance, on development, on housing services, on housing management services, on crime prevention, safety activities, and model activities. The Indian housing assistance is described in the statute under 2021. Activities related to modernizing or operating your formula current assisted stock, your 1937 Housing Act, and things like that. Development, activities related to acquisition, okay? New construction, reconstruction, moderate, substantial rehab of affordable housing, including rental and home ownership housing. Housing services, activities related to providing housing service related services to the benefit or for the benefit of our affordable rental or home ownership participants in support of your 1937 Housing Act or your NAHASDA assisted programs. Housing management, activities related to operating, managing your affordable housing under NAHASDA, assisted with other federal and state funds for the benefit of our low-income Native families. Crime prevention, safety activities under Section 2025. Activities related to providing safety, drug elimination, security, law enforcement measures, activities appropriate to promote safety. Okay, you cannot employ a police officer full-time. Okay, they have to be serving just your low-income people, not your other tribal people. That's where you get into those, iffy areas. So model activities designed to carry out the purposes in NAHASDA specifically approved by the HUD secretary. Whenever you read approved by the HUD secretary, if you put it in your IHP and they approve your IHP, it's considered approved by the secretary. So your planning and your administrative cost under Section 101H of NAHASDA, there's certain amounts that you're allowed depending on your threshold of what you receive. Your P&A includes salaries of individuals engaged in administering, managing affordable housing activities, expenses of preparing your IHP APR. You can pay for somebody to do that. That is limited, but is not limited to the cost of overall program and administrative management, coordination, monitoring, evaluation, preparation of the IHP APR, data collection, transition cost. You can challenge your formula and any cost associated with that. Administrative and planning expenses associated with the expenditure of non-block grant funds on affordable housing activities if the source of your non-block grant funds limit the expenditure of funds on such administrative expenses. Yeah, say that again twice and fast. So planning and admin, staff and overhead costs directly related to carrying out your housing activities can be either determined to be P&A or an eligible cost of your affordable housing activity at your discretion. Generally, costs related, payroll, contractor fees only be attributed to one activity are direct cost and would not be included in P&A. Costs that cannot be attributed only to one activity are indirect cost and included in your P&A. You can read about that at PIH Notice 2023-30. That is planning and administrative expenses in the Indian Housing Block Grant Program for guidance on eligible expenses. Okay. And per the program regulations at 1,238, if you receive grants in excess of 500,000, you can utilize up to 20%. If you get 500,000 or less, you can utilize up to 30% for your P&A cost. Okay. You can request HUD's approval to use a higher percentage for the administration and planning, but you have to identify the percentage of grant funds which will be used in your IHP. So your examples, recipients must report on your affordable housing activities in your IHP and your APR. Basically, this will show you and give you guidance on some of the examples of activities of those use of funds. So example, eligible activities, modernization of your 37 Housing Act units, operation of your 37 Act, development is found under Section 202, acquisition or rental housing. Remember, whenever you buy land, you cannot pay over fair market value for that land. We got rules following them for all of that too. Development under 202, acquisition of your rental housing, construction of rental housing, rehab of rental, and acquisition of land for rental housing development, including costs associated with the acquisition of land for the housing development, such as the purchase of real property, site improvements, utilities, infrastructure, project financing, demolition, and cleanup. Development of an emergency shelter could be under 202, conversion of other structures to affordable housing, and other rental housing development, which is the cost associated with the development of rental housing, not identified, halfway houses, elder housing, transitional housing, youth aging out of foster care, supportive housing, workforce housing, essential families housing, domestic violence shelters, law enforcement housing. So those would all fall under that category. Acquisition of land for home buyer unit development, new construction of home buyer units, and then your acquisition of home buyer units. We had my chairman at one time pushed very, very hard for home ownership. We used to purchase the mutual help units back from our tribal members once they conveyed. If we would have the families come and say, we used to have a family of 5, now there's just me and my husband. Would you like to purchase this unit? And then we would try to get them into a smaller unit that was, more affordable for us, for them. And we couldn't, build a house as cheap as we could buy them back, so you can do things like that with your money also. Down payment, closing cost assistance, lending subsidies for home buyer loans, other home buyer assistance, rehab, infrastructure. So this will should list it under, your housing services, your tenant-based rental assistance, other housing, payments to avoid foreclosure, first and last month's rent, housing fares, sports and recreation equipment, travel purposes for residents participating in community sports. They did away with things like the youth sports grants and things like that. And they said, if you want to undertake that activity, you can utilize your NAHASDA funds. So these are the methods in which you can do that. Housing management services and the operation and maintenance of your units. And then crime prevention and safety. Whoa, almost did it. Okay, and then your model housing, job training centers, home loan revolving funds, community generator. Thinking we need that, after our big ice storm that we had up here. We could probably use a generator system. And then your reserve accounts. When your stuff goes, like I says, it all goes at once. So that is it for today, guys. I ran over almost, 11 minutes. I'm sorry I did it again. Please come back tomorrow, though. Stay around for my lady. Are you there, Brooke?
Yep, sorry, I was just grabbing that webinar feedback survey link to put in the chat.
No.
All right, so Cheryl is still here. If you guys have any follow-up questions, please feel free to put them into the chat. I have also put the webinar feedback survey into the chat. There were like 17 people on yesterday. I only got 1 response. I was so disappointed. So hopefully some more of you can respond today. It helps us with our data to maintain our grant. I usually don't mention that part, but it is important for Native Learning Center to continue putting on webinars and putting on trainings for free. But it also, it helps us know what's working well, what you guys find difficult, what we can improve upon. There's a spot for you guys to suggest future webinar topics that we can try to get on the board. And we also share that webinar feedback with our instructors. So it helps Cheryl as well. They are anonymous, so you don't have to worry about your name being attached to it. It's a completely anonymous survey. So, be candid, but it just takes like 2 or 3 minutes to complete. You don't have to answer every question, and it really is helpful for everybody all the way around. We are going to be back tomorrow at the same time, same place for day 3. Remember, on this new system, you don't have to re-register each individual webinar. Now that you have a profile on Constant Learning, this website we're on now, you'll just log in tomorrow during the webinar time, and you'll be able to click on that green banner and join. So it's 2 p.m. Eastern, 1 p.m. Central, 12 p.m. Mountain, 11 a.m. Pacific, and 10 a.m. Alaska. We'll be posting these recorded webinars to our YouTube channel. We have a Cathedra Webinars archive playlist. I do encourage you to check that out, even outside of the webinars this week. We have them going back, I want to say like 2 or 3 years. So it's a really good resource. That's obviously free for you to access as well. And then if it's a webinar that was put on this specific learning platform, you'll be able to find all the materials and all that for it here on the website as well. But we hope you can check out our other upcoming training events. We post about them on our various social media. We're on Facebook, Instagram, LinkedIn, Twitter. We do have a podcast that we produce in-house, the Hope a Thing, a Native American podcast. So if you are a podcast listener, you can check that out wherever you listen to your podcasts. And we also post the interviews with our special guests to our YouTube as well. So if you like to more watch your podcasts, you can do that too. That is all we have for you today. Thank you guys so much for joining us this afternoon again, or this morning if you are in Alaska. And we will be back at the same time, same place for day 3. So we hope to see you there. I'm going to go ahead and keep the room open so that you guys have access to those links in the chat. But I am going to turn off the recording now.